What you're looking at is the proof that I promised you. These are a simplified version of the statements from the IUL policies that I built for me and my wife. For your convenience and to make it easy to understand, I've taken the information off my actual policy statements and I put all the information in a spreadsheet. One was started in 2003 and the other was started in 2006. The first policy that you're looking at is for a $100,000 guideline single premium. What this means is this was the maximum amount of money this policy could hold. The second was $325,000. Because this is the largest policy, this is the one we're going to take a closer look at today. So here's the big question and the reason why you're here today. Why did I choose to use a life insurance policy over the stock market to protect and grow my money? Do you remember 2000, 2001, 2002? It was right around this time that I was looking to invest the profits from the sale of our business. Yet I had just witnessed 3 consecutive years of decline in the stock market. That had never happened before in my lifetime, and I wasn't about to risk our life savings speculating on what the stock market was going to do. After 2 years of studying, I was finally convinced that the Index Universal Life was a safe place to put our money, and that was in the year 2003. Everyone I knew was complaining about their retirement savings being decimated in the equity market. I still had all of our money from the sale of our business in a bank account because I opted not to expose it to any of the market risks. I'm risk adverse. So I started by sticking my toe in the water and I purchased a small Index Universal Life with a portion of our savings. I needed to prove to myself that the Index Universal Life product was really what I thought it was. When I purchased my second IUL, I was all in. I had verified my analysis with the first policy, and so I put all the rest of our money in the second policy. This has been by far the best financial decision I've ever made. Because of the lock-in and the reset of the IUL, which I'll teach you about a little bit later, I was not exposed to the market risk like most people were in 2008. I had no anxiety about losing any of our money. I slept like a baby. Let's review the truth and facts. How do we do that? We look at how the money performed historically. Remember how I proved in my book, math and money doesn't always work the same? So that you are comparing apples to apples on policy number 2, I have given you an example of what would have happened to my $325,000 if I would have invested in the equity market. The IUL information is on the top, and the equity account information is on the bottom. The comparison starts in 2006 and shows what my balances are by the end of 2014. These are the historical returns I would have received from an S&P 500 equity index with the dividends. I used a 12% tax rate, so no one would say I exaggerated the benefit of the IUL. I'm guessing your income tax or capital gains tax are double that. I'll leave that up to you to work your own numbers. I also used a 1% management fee. Again, ultra conservative, and so that all is equal, I included the annual expenses to purchase a $1.5 million 30-year term life insurance policy. I used a male, non-smoker, marathon runner who could qualify for Super Preferred Plus ratings to price the annual premiums. So if you make very little annual earnings to be in the lowest tax bracket, you can find an inexpensive money manager, and you're a marathon runner type person who can qualify for Super Preferred Plus health ratings, then these numbers are realistic. If not, the equity account would perform much differently. This is done so that no one could say that I exaggerated the benefits of the Index Universal Life product. Plus, I wouldn't want my family not to be protected if I had all my money in an equity account. I'm showing you exactly what the gains were on the IUL policy number 2 and the S&P Index equity account. The value of the IUL at the end of 2014 is $445,000, and the S&P equity account finished at $517,000. I would have made 6.4% in the equity account, and I actually made 4.3% in the IUL. I know what you're thinking. You're thinking, I wouldn't do that because I'd lose 2%. Keep in mind, the last 10 years, except for 2008, the market performed exceptionally well, and it only outperformed my IUL by 2%. Be aware, the IUL is growing tax-free and is becoming less expensive every year, while the equity account gets more expensive and is subject to future tax changes. So from my perspective, I received nearly the same returns a bull market created without being exposed to any of the market risk or tax risk. My money is growing in a tax-free environment with the cost becoming less every single year. When the market does take a downward turn, all my cash and gains are protected. And best of all, this financial product will self-complete if something were to happen to me prematurely. I always will have in place my permanent life insurance benefit of $1.5 million that would go to my wife and my daughter, unlike the term policy that will eventually go away. Think about this. When we experience another market correction, like the one in 2008, my IUL will kick the pants off the equity account, and while thousands of people will lose massive amounts of their retirement savings, I won't lose a penny because my IUL protects all of my money. And that's exactly what I want for you and your family. Let that sink in for a moment. We've had an unbelievable run since 2009. How bad will the next correction be? This is something I believe you really need to ponder. Is the risk really worth chasing those extra few percentage points? If you're starting to think, no way, it's not worth the risk, I want to invite you to continue to watch as I uncover more benefits of the IUL that most people and even some advisors don't even understand. On page 114 of my book, I cover one of the other important features of my IUL versus an equity account. That is, my cost in the IUL is going down the longer I own it versus the increasing cost of the equity account. Take a look at the cost here. I want you to notice what it cost me in year one and what it cost me in the last year. As my policy ages, it costs me less to own. As the equity portfolio ages, the more expensive it becomes. In 2006, the total cost of the equity account was $5,000. By 2014, the total annual cost grew to $16,000. No one ever points that out. Notice how much it's increased since the beginning, and it's only going to get worse as the account grows. Even if the market gets clobbered, these fees never go away and are always present. So let's look at the cost of the IUL. It started out more expensive at $9,000, and by 2014, it went all the way down to $3,000. And this cost will continue to decrease in the IUL as the cash value increases. When you compare the cost of the equity account versus the IUL contract, you can see out of the gate, the IUL policy is more expensive. This is one of the reasons why most people will not even use these contracts for accumulation. They're not patient enough to wait to take advantage of the big decrease in annual cost. This happens when the earnings on the cash value are higher than the cost of the policy. Notice when this happens. It happens in year 4. So let me ask you a question. Where can you put your money and make all these things happen? I haven't seen anything other than an IUL. And that's why I call this my family financial miracle.